a self-insurance roadmap facilitating the growth of Asian businesses. This will be presented by Mr. Oliver Schofield, the head of Captive and Art Consulting, Principal Re. Oliver brings more than 30 years of captive and alternative risk transfer or art experience to his clients. He has held a number of executive positions in the global captive and art sectors since the mid-1980s. His particular area of focus has been the incorporation and reinsurance of captives, cell captives and association captives, and a myriad of art structures for a range of different industries from across the world. Ladies and gentlemen, please give Oliver Schofield a big, warm Malaysian round of applause.
Thank you very much, and good morning, ladies and gentlemen. It's an absolute honour and pleasure to be here this morning to be able to share with you some of my views and thoughts as to how captives in this region can be used as a mechanism to drive growth within Asian businesses. My special thanks to the organisers for putting on such a great event and for inviting me to be able to share with you my excitement about the growth opportunities that exist in this region, to share with you my views about how important it is that captives can very much play a role to help drive the growth of those organisations that sponsor them, and also to spend a little bit of time talking about... That was perfect timing, because I was about to say talk about technological disruption, and I've just been technologically disrupted. Anyway, to talk about the disruptive digital distribution role that captives can play as well. But I'd like to start by looking at what do I mean by the growth opportunities that exist in this region. How can captives help drive that growth for the organisations that sponsor them? So we'll start off by looking at, across the world, how captives and PCC structures have grown quite astronomically over the last 35, 40 years. Then I'd like to look at, in the second section, how captives can be part of that driver to see ever more increasing profitability for organisations in this region. And then thirdly and finally, to look at the role that the insurance and the reinsurance market has to play in delivering alternative solutions to support the captives' overall objectives. Captives have been around for a very, very long time. There's a point of argument as to how many years they have actually been around, but for the sake of today, let's take 1950s as our benchmark start point. As you'll see, from 1990 through to 2000, there was quite a rapid growth. 1,000 new captives were put on. And then as we went from 2000 through to 2010, we saw an additional 2,000, double the amount from the previous decade. And over the last 7 years, we've seen another 1,000 captives be established. A lot of that was fueled by the creation of the PCC structures back in the mid-1990s, and that helped drive that doubling of the increase in captives from 2000 through to 2010. It's also been driven by much more awareness in the availability of captive vehicles and a reduction in the barrier to entry when it comes to the point of view of the amount of premium spend that needs to be within an organisation to justify setting up a captive. If we look at the regional approach to life, we've seen that there are now more than 6,500 captives around the world. There's more than $150 billion of premium that flows through those captives, and there's more than $256 billion of assets under management. To me, that says it's a very, very robust, mature, dynamic industry. What does it mean, though, when we can't start considering the growth opportunities if the industry is already so well mature and so well developed? I think what is important is that we look at how captives are shifting their role when it comes to what they can deliver to an organisation. They are no longer, in my opinion, just a formal risk retention vehicle driving best risk management practice. That, of course, is critical and key to any organisation that decides to establish a captive. But to me, they are also now a new dynamic profit centre within an organisation, looking to try and monetize all the risks that an organisation has from simply being in business. And I'm going to explore some of those themes as we go on a little bit during this talk. As far as Asia is concerned, going back to those figures from the previous slide, 6,500 captives, of which 133 are Asian parented, 2%. $150 billion of global premium, of which $1.5 billion is underwritten by captives in this region, just 1%. But then you contrast that and look at the global GDP that is contributed from this region at around 30%. Is this a disconnect? Maybe. I see it as an opportunity, a very large opportunity. It's not a bad thing, because we're on the crest of a wave here when it comes to the further innovation of digital distribution of the technical know-how that exists. I believe this region is ready to capitalize on that, and this should be a very, very exciting time, and events like this help us come together and drive that growth and drive that sharing of the knowledge that will benefit from these exciting times. But why is Asia potentially viewed as being underweight in terms of captive usage? I think you need to consider what the hurdles have been in recent years. I've heard from talking to many people in this region that one of the reasons why captive growth has been perhaps slower take-up than others is to do with the education, the awareness and the availability of solutions. And events like these help us to share that knowledge and try to get a better understanding of the technical know-how that exists within this region, as well as technical know-how that exists outside of the region that is being brought in to help drive that business growth. The actions that are being taken include the training and the knowledge and the market support. I think as the market practitioners, we have a very real responsibility and role to play in developing ever innovative, ever increasingly sophisticated solutions to adapt to the ever increasing sophisticated nature of our client base. We've heard from our first speaker how digital transformation is running across this region. Well, that same sort of transformation has to exist within the insurance and reinsurance space to be able to support that continuing transformational growth. I suppose the overall objective of trying to increase the usage of captives and self-insurance mechanisms in this region is, in my opinion, twofold. First of all, is to take the rich, successful companies and make them richer and more successful. Secondly, I think we need to consider the common good, how captives and alternative risk vehicles can be used to drive increasing use of insurance on a micro-insurance level. Recently, a program was put together in Latin America by the World Bank that has been incredibly successful in driving insurance into areas where perhaps locals would never have actually considered buying insurance. That is an important role for us in the risk financing and the alternative risk financing world. So how can we start to drive that change in this position? My challenge to all of the buyers and users of captive is be bold. Be bold in your risk management planning. Don't just think about the traditional risk exposures that exist within your organization. Think about the other risk exposures that exist within your organization that cannot necessarily be transferred to a third party. Challenge your providers, your insurance companies, your brokers, your consultants, your reinsurers. Challenge them to develop a forward-thinking, multifaceted, long-term captive journey. A captive isn't just set up and then left there. A captive should be very much dynamic, risk financing, profit center within an organization. We need to consider the captive's life cycle. We need to identify how the captive can be used more creatively to drive alternative thinking, to drive an alternative viewpoint of risk versus reward. So let's consider the captive life cycle. And let's consider what some of the risk drivers are within a captive life cycle, the typical solutions that are available, but try and tailor that to today's environment. You see on the slide there a typical life cycle of a captive. Ignore the purple box for the moment. The build didn't quite work on the slide that I was hoping for, so ignore the purple box, please. Just look at the white boxes. What I'm trying to show here is the life journey of a captive from the very fledgling, early, new days of its existence. In that time when it's just been created, perhaps it's being used for the formalized self-insurance opportunities that exist, looking at self-insured retentions and how they play within the organization. And typically we might see a captive using the traditional lines of cover, property, marine, liability, and so on. And their solution providers are very much the traditional covers, coming from the traditional insurance and reinsurance marketplace. As the captive grows into its next phase, the growth phase, we might see more lines of business going into the captive. For example, trade credit, employer's liability, motor, employee benefits, and so on. And wonderfully, the captive is driving for stability in terms of the premium that it pays, stability in terms of the maximum losses that it might assume in any 12-month period, stability from the point of view of the markets with whom it partners. They might be looking at multi-year programs. They might be looking to lock in the terms and conditions that they've got. They might be looking at sideways protection, stop-loss reinsurances, and so on. And as they move through to the mature stage, maybe they'll be looking to run off some of their lines of business. Maybe that's because they've decided to exit one of their subsidiaries and they need to close down that particular exposure in the captive. And that's a great use of the captive. But it's very traditional. It's not really that exciting. So how can we turn that into something that takes a different position within the overall financial organisation of its parent company? Now you can look at the blue box, purple box even. I've often felt that captives have been underutilised when it comes to being an important part of the financial growth and financial management of organisation. Let's move away from just being the traditional property, casualty, marine, liability, etc. Let's move into the non-traditionally insurable risk exposures that exist within an organisation, because that is risk that is inherent in a company. But are there ways that we can actually monetize that risk? Are there ways that we can drive the profitability from identifying risks within the business that can help be used through the captive and help support the parent's overall growth aspirations? But what does that actually mean? And how can that actually be achieved? Because it's great to be able to stand up here and pontificate about how captives should be the new great thing within an organisation when it comes to profit generation. So I'd like to just run through a few examples and the process that can be adopted to help drive that growth. I think the start point has to be, going back to a comment I made earlier, about being bold. Be disruptive in your own business. Let's not just consider traditional insurance. I talked about looking at the many risks that exist within the business that cannot traditionally be insured to a third party, but they absolutely can be monetized and create a premium flow and income flow into the captive. How do we go about doing that? Well, I think the first thing is that we need to identify all of the risks within the organization. Okay? So yes, we know we've got all the traditional stuff, but what else is within the business? Risks that may not fall within the insurance and risk management space. So we start talking to finance directors, we start talking to the treasury function, we start talking to other businesses within the overall corporation to try and identify what are, simply put, the risks of us being in business. Once we've identified those, we need to think about how we can quantify those. If one of those events did happen, what would that mean to our balance sheet? How would that destroy or not our company in the event that that did happen? We can then determine how much it would cost to actually be able to protect that internally. What sort of funding do we need to consider to be able to support the protection of the organisation against those events happening? We can then start thinking about how we can allocate a premium to those risks and charge them back to the divisions, and hence you have a monetised risk stream. Let's look at some examples. And all of these are real-life examples. I haven't just made them up for the sake of it. These are real-life examples. So we'll start with the first one, an agricultural example. There is a particular organisation in a part of the world, trying to obviously be very careful that I don't disclose who that might be, but there's an organisation that's involved in food trading. So they buy and sell food, and then they ship it all over the world. One of their biggest risks is if they buy food, a particular product, let's call it poultry, they buy chicken, and they buy it for a price of 100. Their objective is to sell that on to their clients for 120. Why not? Make a 20% margin on it, of course. If they don't reach the 100 point, they have a commodities hedge in place to protect them against a downturn in the market. Fine. But what happens if they sell it for 110? Yeah, they've made a 10-point margin. Wonderful. However, that may not be sufficiently high to be able to reward the traders that are involved in buying and selling that particular item. In a small organisation that is trading, they have to be able to bonus remunerate their traders to such a level that those traders do not decide at the end of a financial year to up sticks and move to another firm. Their asset is their traders, and they need to look after them. So we devised a program whereby we would take 0.01% of every single trade and call it premium. That would flow into the captive, and in the event that we got to the end of a financial year and the overall price point had not been met, they hadn't hit the 120, they'd only hit the 110, then the captive would pay a claim to enable the bonuses to be paid to those traders, to enable those traders to stay in the organisation. That was a way of being able to monetize the risk that the organisation faced. It couldn't be transferred to the traditional insurance or reinsurance market, something about financial guarantee not being a particularly interesting class for the markets. However, what that company successfully did was to enable its continuation of trading with those traders. It also enabled them to be able to grow their business because they knew that they had those traders set within their organisation for a longer period of time. Another example, I'm going to call it the Amazon example, but I promise you this has got nothing to do with Amazon. I've never met Amazon, but it's quite a good example. If I give you the name Amazon, it'll get into your head. We buy stuff on Amazon, we expect it to be delivered on a certain day. What if it's late? What compensation do we get? None. Okay, so why don't Amazon, to try and steal a market share, well, they've got quite a big market share, but there are other delivery firms out there as well, why don't they actually guarantee that delivery? And they say to us, if we don't deliver by 3 o'clock in the afternoon, on the day that we told you we're going to deliver, we're going to refund your full postage and packing. Why not? We're not going to refund the cost of the goods, because you've still got the goods, maybe a day late. But we're going to refund the cost of the postage and packing. As a customer, you feel, oh, great, thank you. They've done something to support me here. I'm going to use them again. Customer satisfaction levels go up. That's great. Customer retention levels go up because you feel you're being looked after. How do they pay for that? Because obviously they're reimbursing the post and packaging. They're losing their margin. So what they do is they charge, again, I don't know, 0.01, 0.02% of every single delivery cost they charge into the captive as a premium. In the event that they are late in delivery, automatically a claim is paid back to the customer. Now, this is where the digital disruption comes in, because if you do that on an automated underwriting platform, the moment that somebody buys an item, they pay for the postage and packing, that percentage of that cost immediately is transferred through a blockchain, whatever it might be, straight into the captive. And in the event that the delivery is late, everybody knows where everything is, with the tracking devices available on mobile phones, tracking devices available everywhere nowadays. There is no claims adjustment, there's no discussion as to why it was late or whatever. It was late, it automatically gets paid by the captive as a claim. It's a very simple trigger, there are no exclusions, it's all very digitized, but it's a way of monetizing the risk that the organization faces, but also delivering enhanced customer service to their clients. A third example, the TechCo example there, I'm going to pick on the trade credit harmonization. I have a particular customer that has a very, very, very healthy credit rating, actually higher than any of the insurance companies with which it trades. So kind of ironic that when they're dealing with their bankers, again, they have a higher credit rating than their bankers, it's kind of ironic that the bankers and the insurance companies demand that they buy a fronting insurance policy for their captive for the trade credit when they have a better credit rating. But that's just one of the facts of the life that we live in. So they were required to have a rating within their captive. And they decided that rather than just having a rating in their captive to satisfy the insurance market, they were going to take this themselves. They're going to harmonize all of their worldwide trade credit policies into one. They're going to put it into the captive with a parental guarantee, because the parent is rated at AA+, put it a parental guarantee, and therefore totally remove themselves from the insurance market, because that particular insurance market could not satisfy their needs. They were an organisation that had 0 losses in their trade credit policies going back 20 years. But every year they were paying premium away to the market because the market insisted that they had to do that because of the credit rating that was required by the banks. All of a sudden, they convert that into their captive, get the captive rated, get the parental guarantee, and you have a new revenue stream, a new profit stream for the organisation. So those are just 3 examples that we're seeing in our business we're seeing in various markets around the world of how different ways of using the captive can actually help protect the business, but also more importantly, drive its profitability. Now, I'm going to give credit to this slide to Swiss Re. This was an example that they used quite a long time ago now, probably about 15 years ago, but in the European market. And I think it's very, very pertinent and very relevant today. So if there's anybody from Swiss Re here, thank you for the inspiration for this particular slide. The role that reinsurance has to play is a critical role. Reinsurance should be and must be always innovative. It must be always supportive to an organisation and to a captive. It must be committed long-term capital. And certainly the reinsurers that I've traded with over the years would agree with those comments. I'll just build that slide. There we go. Quite a complicated slide, lots of stuff going on there. But what I'm trying to show here is that there are many solutions that have been around for a long, long time, and each one of these retains its relevance in the captive world today as much as it did 15, 20 years ago. The challenge to us is to find the right solutions for those organisations that are embarking on the captive journey, and to make sure that those solutions are tailored to the specific individual needs of those captives, especially when they're getting involved in non-traditional insurance risk exposures. So if we looked at a couple of those bubbles there, we've got contingent capital in the top left-hand corner, and we've got multi-trigger on the far right-hand side. These are not new, as I said. However, their usage, by blending those two together, can actually support a captive in the event that it has its annus horribilis right at the beginning of its life. So imagine a captive decides, in some of the examples I gave, to protect its traders or to protect its customers through its customer innovation insurances, as well as putting together in there its traditional lines of property, casualty, etc., etc. That's great. If it self-insures all of that, what happens if everything goes wrong in the first year? It needs access to a contingent line of capital. And that's exactly where the reinsurance market comes in. But I hear you cry. The reinsurance market won't provide cover for non-traditional insurance risk exposures. So how does that help? Well, there are many ways of designing that. And one of the best ways is to have a blended pool of risks within the organisation. So you have your property, casualty, and so on. But you also put into your captive the non-traditional risks that we talked about. And by putting those in, you can then put an aggregate cap on the amount of exposure that the captive can face in any one year. Because the more innovative reinsurance companies will allow an element of cover from those non-traditional insurable risks to be passed into the reinsurance market, so long as it is part of an overall portfolio protection. And by blending together the access to contingent capital, let's face it, that's what insurance really is contingent capital, along with a multi-trigger policy, so you've got property's gone wrong, liability's gone wrong, maybe the customer service has gone wrong, and you've eaten up the overall aggregate exposure of the captive, at that point, the reinsurance market will come into play and will accept, in that case, some of the non-traditional insurable risk exposures. It's all about the quantification. It's all about the identification of those risks. And it's all about being able to share that knowledge with those markets. Exciting times. So, in conclusion, I won't read through those bullet points. I'll let you read them yourselves. But I think, above all, what we're trying to do with captives nowadays is to build a holistic, disruptive view on its parent's overall risk profile, and to try and embed a mentality into the organisation that the captive must be, absolutely essentially must be, a new profit centre for the business. If a captive cannot be seen as being a profit centre to the organisation and a profit generator that helps to drive a company's growth, then why bother having the captive in the first place? Thank you very much for your kind attention. We've got about 5 minutes or so for questions. I was asked to crunch it down to 25 minutes instead of the allocated 30. So I'd be more than happy to take questions on anything to do with my presentation, or if you want to talk about anything else, we can do that too.
So your questions, ladies and gentlemen, please send it via Slido, the app that we explained just now. Let's see if we have any questions. Oh, we do already.
Okay, I'll look at the first one. If a company's main objective is to internalise risk management and not merely profit making, is a captive suitable solution too? Yes, it is, very much so. It goes back to what I was talking about, the captive journey. When a captive is set up day one, it is not going to be the panacea to absolutely everything within the organisation. It's going to be a journey. So day one, it starts about internalising risk within the organisation, easily identifiable risks, risks that run through the insurance department, the insurance management department, the property, the casualty, the marine, etc. So that's how it starts. Not all captives will make the step to go from traditionally insurable risk exposures to some of the stuff I was talking about. I couldn't give you a percentage figure as to how many will, but not all captives will take that leap. My point is that they should consider taking that leap, because then the captive becomes more than just an internalised risk management tool. And please don't think that I'm being negative by saying just an internal risk management tool. It's a critical piece of equipment within the risk management armoury. But yes, I believe that it very much has value as that as well. What's the next one? Oh, thank you very much. That's much easier. That's a great question, the second one there. I do remember a long, long time ago, I was talking to a particular insurer. I won't say who it is, but a particular insurer in Europe. That's as far as I go on that one. And we had a client that had been with this insurer for 15 years or so. They had their own deductibles, and then the insurer participated immediately above the deductible level. And we went to that insurance company and said, hey, we'd like to set up a captive with our client, with your client, our mutual client. And they got very upset. They said, well, we're going to lose premium. And we said, well, yeah, but what you're actually going to do is also reduce the amount of risk that you're facing, because you're no longer attaching excess of 100,000 euros. You're now attaching excess of 5 billion euros. You're also gaining a partner that is very serious when it comes to risk management, a partner that wants to drive claims out of the business as much as they possibly can, because they're now participating in that first layer, the primary layer of insurance. So they are serious about risk management. Surely that's a good indicator to you that that's what they want to do. And I do remember back in the late 1980s, when I was a casualty reinsurance broker working with captives, walking into the Lloyd's building and talking to Lloyd's underwriters who would say, get out of our building, because they saw captives as a direct competitor. Eventually, they got what it was all about, and now are very, very supportive. And sometimes will say, well, why don't you have a captive? Because that, to us, demonstrates your robust approach to risk management. What are the most sensible first lines of business to consider for a captive? Well, I suppose it depends. How about that for sitting on the fence? It depends. It depends really what business, what industry the organisation is in. Assets, liabilities, well, are they asset heavy? Are they liability heavy? Are they something like an Amazon, for example, that has huge amounts of facilities and warehouses all over the world? Or are they perhaps a bank that doesn't own its assets, but constantly has, obviously, its liability exposures? So it very much depends. I think, really, year one, don't overcook it. Don't be over-aggressive. Put in the traditional lines of cover with a view to thinking how the captive can then develop and evolve with the organisation. Some of the things I was talking about are not for year one, but they should be on the agenda, even though they may not be executed till year 3, year 4, year 5. How do you classify customers' protection as captive insurance business? Well, in the same way that I classify any other type of insurance. So if I'm offering a customer insurance, then it could be for mobile phone theft, loss, damage. It could be for motor. It could be for household. That's all customer insurance and protecting your customers. But it is also business that could be put into a captive. What would be the most... I think we've had that one already. Yeah. Can a captive model handle the tackable business as a non-profit organisation? I will confess at this point that I am not, by any stretch of the imagination, an expert when it comes to tackle. However, my basic understanding is that because the regulators within Labuan have enabled PCCs and captives to be operated in a Sharia-compliant way on a tackle basis, then they absolutely can be used, or captives can absolutely be used for any exposures that those organisations face. Do you see... Well, it's just vanished. The one about ACE and XL was there, and it's just gone. So I don't have to answer that one. Captives are managed on a somewhat confidential basis, hence newcomers have no right reference to embark on this. Yes, they are very much confidential. However, some of the knowledge and some of the experience that the practitioners have in the marketplace, whether that's the consultants, whether it's the insurance brokers, reinsurance brokers, insurers, reinsurers, that knowledge has been built over many, many years. And whilst ideas are confidential, whilst company names are confidential, there is no one size fits all. There is no one off-the-shelf product for organisations. Therefore, it's a blend of the experience, it's a blend of the knowledge that has been used and deployed in many other organisations that is there to help other captives drive and other captives be used for their protection.
Probably one final question.
Yeah, I'm not going to answer that latest one because it's not an area that I have knowledge about. I could make it up. Right, captives or PCC for microinsurance, is it feasible in Asia? I believe so, yes. I think the World Bank has been, working with Swiss Re and one or two other major reinsurers, I think Munich Re were involved as well, have been very forward-thinking in the way that they try and bring insurance to communities that would never necessarily thought about that type of financial or risk protection, particularly on a cooperative basis within the communities. The question really, I suppose, there is who would own the captive or who would own the PCC? Because would you expect the local communities to own it, or would you expect some form of cooperative or community bank to potentially own the captive or the PCC and then provide that protection to the local communities? I would think that's a much better way of trying to structure that, because you get too many challenges where you have too many individuals who don't have necessarily the knowledge or the background in running a PCC or a captive, because let's face it, their trade is farming, their trade is from the land. It's not in finance. So I wouldn't expect them to be the owners. I'd very much expect that to be something else. But yes, resounding yes, captives and PCCs are feasible in Asia for microinsurance, and it's something we should champion.
And with that, ladies and gentlemen, join me in a big round of applause. Thank you so much to Oliver.